All right, now, when you started learning accounting, you were taught the transactions of a service company. Why? Because those transactions were simple. They cut your hair, you paid them money. Fix your car, paid them money. A service company provides a service. Doesn't sell you anything, but provides you a service. And those transactions are simple. And you learn the debit and credit system, and you learn the income statement. Simple income statement. Revenue, from cutting hair, minus all the expenses, rent, and everything else, gave me net income. Then you learned the transactions of a merchandise company. Now, a merchandise company like Carrefour buys in products, thousands of those products, doesn't do anything to them except put them on the shelf and sell them to you. That's what a merchandise company is. So now on the balance sheet, you had one more asset, and that's called merchandise inventory or just inventory. So you see, Carrefour has one account called inventory. When it buys in bread and milk and cheese, it debits that account. And when it sells it to you, when they scan it, you know, when they're scanning it, they're deducting it from inventory and they know the cost of it. So they have one account, and it's a perpetual inventory because we know exactly, we have a record for every item that we have in inventory. That's a perpetual inventory. Periodic inventory means I have to stop at the end of the accounting period, figure out what my ending inventory is, and then that way determine how much I used up. We'll get into it. But the textbook is going to be using some kind of periodic inventory sometime, but we are always going to deal with perpetual. Because that's the way life is today. Everything has a barcode. That's what the barcode is doing. You understand that, right? So the income statement now for a merchandise, it had one more asset account called one inventory. And the difference now in the income statement was you had revenue less the cost of goods sold. That gave you gross profit, and then you subtracted all the operating expenses. Right? So that cost of goods sold section is the cost of the items that you sold, and you knew what they were exactly because you paid for them. And you know what they cost. But now, and the transactions were a little more complicated for you. Because when you're dealing with inventory, inventory can be damaged, can be returned, could be discounted. I sell the inventory to a customer, they can return it, they can get a discount. So you have to learn the transactions that relate to the inventory. Okay. All right, so from there, we are now going to revisit or look at the accounts that relate to a manufacturing company. Now, let's say I'm manufacturing this desk. A manufacturing company buys in what we call raw material. Raw meaning it hasn't been worked on. So for manufacturing desk, they buy in big chunks of wood, a whole bunch of metal. All right. And then they put that through a transformation process. They add direct labor to it. They add indirect materials. They add heat, light, energy, machines, rent, all of those costs to convert the raw material to finished goods. So now on the balance sheet, the difference on the balance sheet for a manufacturing company from a merchandise company is simply that we have now 3 inventories that we account for. The raw material inventory, the math from the skillet, we know what that is. We paid for the big pieces of wood and the metal. So we purchased it so we know what it costs. But now we take it and we work on it. And now we're going to track the direct labor work that goes on it, and we're going to accumulate all the indirect costs. We know the material because we took it from raw materials, so we know that. And we're going to keep track now of the labor costs, direct labor. And then we're going to accumulate all the other indirect costs. all right, in the form of a manufacturing overhead. So there's my three cost elements: direct material, labor, manufacturing overhead. And I'm going to account for this, and then when it's finished, I move it to finished goods. So basically on the balance sheet, we have three inventories: raw material, work in process, which we have to determine as we go through here, we have to be given that, and then the cost of the goods that were manufactured, completed, and transferred to finished goods. Then when we sell them from finished goods, it becomes the cost of goods sold. All right, it's just bringing back all kinds of good memories, eh? So the cost of goods sold, but we're going to be doing it with a perpetual inventory system. And again, just visually, this is what we're talking about. A merchandise company, if it's on a periodic system, it knows what it started the year off with, it knows what it's purchased, and it counts the inventory at the end of the accounting period to give them the cost of goods sold. The units they had available minus the units they haven't sold yet is equal to the cost of goods sold. Well, the same thing down here in the manufacturing. But this is a periodic inventory system, not a perpetual. So we're going to simplify it as perpetual. But they're giving you a visual here. The manufacturer, finished goods, this is what I have to start the year in finished goods. This is what I manufactured through the whole year. So I have these two available for sale. And this is what I have not sold at the end of the year. So the difference must be the cost of the goods that I sold. Okay. So when we look at the income statement, again, this is a periodic. Merchandise inventory, add the cost of goods purchased, which I know very easily because I paid for them. Gives me the cost of goods available for sale. I simply count what I don't have left, and that gives me the cost of goods sold. But for a manufacturer, looks the same, but we're talking finished goods inventory here. We add to this something new called the cost of goods manufactured. There's a new statement here. And that gives us goods available, less the ending finished goods inventory gives the cost of goods sold. So now for a manufacturer, we have three statements. Balance sheet, we have three new accounts on the balance sheet: raw material, work in process. Income statement that looks very much the same as a merchandise company. Revenue minus the cost of goods sold gives me gross profit minus the expenses, but now also the cost of goods manufactured. That's another statement. That's what we're talking about here. That cost of goods manufactured is actually accumulating the cost of work in process. When you think of the work in process account, we have what we started the beginning of the year. Beginning of the year, we had some half-completed desks that were left over from last year. I didn't finish them before the end of last year. So that's beginning work in process. It's not raw material because I worked on it. It's not finished goods because it's not finished. Okay, now I'm going to add labor to that work in process and energy costs to that work in process. And I'm finished it, make it finished goods. Then I'm going to start more desks, more labor, more wood, more everything else, and I'm going to keep manufacturing all year long. So to the work in process, I add the manufacturing costs. What are the manufacturing costs? Direct labor, manufacturing overhead. Very good. I add that. So I get the total value of the cost of goods going through the floor. When I add this and total manufacturing, it gives me the total value of everything worked on that shop floor. Now, at the end of the year, I simply subtract the value of the half-completed goods, to get the goods manufactured. So that's your new statement. You see, your new statement basically is an accounting of the work in process. And it looks like this. Now, you might say, oh my goodness, that looks complicated. It's not. It's very simple. It's just what I said. Beginning work in process. Add the three cost elements, which are Material, direct labor, and manufacturing overhead gives you the total amount of work in process going through, subtracting any work in process I got my cost of goods manufactured. Now, this author likes to show you as periodic inventory. I said this is perpetual. I know exactly how much direct material has gone in because it came out of stores and went in. So I'm not going to give you problems like this, but demonstrate if the problem says, okay, direct materials, you don't know what direct materials were used. So you knew what you had at the beginning, you knew what you purchased. To get it, that's available for use. You knew what you had at the end, that's what you used. But really, I know exactly the value of all the raw material I purchased. And when it goes into production, I know exactly what it costs. So when I give you any problems like this, I will always give you the number for direct material used because it's a perpetual inventory. Perpetual inventory system means we have a record for every item in inventory. All right. So he's assuming we don't have an item for everything in materials. We do. So I will give you direct materials used. So now you have direct material used, you have direct labor, you have manufacturing. So, I don't know, I'm going to move over here. As you put together a financial statement, as you learned a long time ago, the outside column is the totals, are the totals. The outside column, work in process. Add cost of goods manufactured, total manufacturing costs, sorry. That's not it. The total manufacturing costs gives me the total work in process, subtract the end work. Now, if you want more information, you move into the inside column. Now, the inside column is a summary of the manufacturing overhead, of the manufacturing costs. This is direct material, direct labor, and overhead. That's your total. Now, I want to know what comprises this. I move in again. And the manufacturing overhead is this. It can be in any order. It probably has a high to low. Yeah, high to low. It doesn't matter. It does not matter in any order. But you know the manufacturing overhead comprises of anything that refers to factory. Remember factory in front office? So when they say factory insurance, man overhead. Factory taxes, man. Factory utilities, man overhead. And anything that says direct, indirect labor, indirect material, anything that says depreciation on that. That is the simulation, all right? So you have these three columns. All right? Any questions? All right, let's join in and have a quiz. Now I want to see 45 people. Okay, 24, 25, we're losing players now. You're back up to 25. But lose it again. Better quit while I'm ahead, eh? All right, question 1 of 4. A manufacturing company calculates the cost of goods sold as follows. Beginning finished goods inventory plus the cost of goods purchased minus ending. Beginning finished goods inventory minus the cost of goods manufactured minus ending. Beginning finished goods inventory plus the cost of goods manufactured minus ending. Oh, come on, folks. No. You forgot, I'm going to go back and check your marks. 200, 201. Come on, the answer is beginning finished goods All right? Plus the cost of goods manufactured gives me the goods available for sale minus the ending finished goods. So only 3 people got that correct. All right, we'll give them a chance again. Question 2 of 4, the cost of goods sold only appears on the manufacturing company's income statement. Appears both on the manufacturing and merchandise company income statement. Is calculated exactly the same for merchandising and manufacturing. Good work. Yes, of course. Cost of goods sold on the merchandising income statement. Cost of goods sold. Question 3. Cost of goods manufactured is calculated. Now we're talking cost of goods manufactured this time, not the cost of goods sold. Cost of goods manufactured is calculated as beginning work in process plus direct material plus direct labor plus manufacturing overhead plus ending with direct materials used, direct labor, manufacturing overhead minus beginning plus ending. Beginning with direct materials, direct labor, manufacturing minus ending with. Very good. 1,725. Very good. Any questions? Now make sure when we're talking the cost of goods manufactured, we're talking with the work in process, the new financial statement. We're talking the cost of goods sold, we're talking the income statement, finished goods inventory. Cost of goods manufactured relates to work in process inventory, cost of goods sold. So on the cost of goods manufactured schedule, depreciation of factory equipment is not used because it is included with depreciation expense on the income statement. Appears in the manufacturing overhead section, is not an inventory of cost. What say you to all of that? Yeah, now we got it. That's great.